Welcome back, viewers, to another episode of Questions with Matt and Mark. This week, Mark, I think it's opportune to discuss what's going on with volatility in the market. Sure. It's been some time since we've seen this type of volatility.
Yeah.
I'll talk about today. Today's January 24th. Just today in the market, from about noon 12:30 until the close at 4, the NASDAQ moved over 4%. I've seen some names recover in excess of 20% in less than 4 hours. Mm-hmm. And I think that just goes to show you that these bouts of volatility come and go with the market. They don't happen very often, but when they do, they're quick and fierce. And I think that there's dislocations between fundamentals and fear-driven capitulation selling. Mm-hmm. And I never think it's a good idea to make those types of fear-driven decisions and sell just because everyone else is selling.
Well, yeah, if you looked at the market at 10 o'clock this morning, you could have been ready to move everything to cash. Mm-hmm. But, if you did that and then you missed the reversal to the upside that everything closed in the green today, you'd be kicking yourself. And that's an example of why we don't make emotionally based decisions, right?
Exactly. And earlier today, Mark and I just got done recording episode 134 of the Independent Advisors podcast. I would tell you, viewers, if you have additional concerns or worries regarding the market, I think you and I did a very good job with that earlier today. Kind of talking about where things stand, put it in the context of how often it happens.
Yeah, and just to remind people, this type of stuff is pretty normal, especially for a midterm year. It tends to be a little bit more volatile than other years. We tend to see weakness in the first half of the year, only to reverse back up after the midterm elections in the fall. Again, just to remind people, it's normal for the S&P 500 to have intra-year pullbacks of 14 or 15%.
And that's what we got.
And that increases to the average of 17% during midterm election years. So as of right now, this stuff is normal for this type of year, I would say.
And it doesn't feel that way, Mark, because we haven't had this sort of correction in some time.
Right.
We haven't had a good correction since February and March of 2020, and before that, it was the fourth quarter of 2018.
Yeah, and I'll just say this, even though we reversed back from red to green today, I don't want to make a prediction, but we may not be out of the woods yet.
Absolutely.
The worst of it might not be behind us yet.
Yep.
So I would just prepare people to see more volatile moves in both directions, up and down right now, just because we are in an extremely volatile environment right now.
To kind of finish up, I agree absolutely with Mark said. So, later this week on Wednesday, a lot of eyes on what the Federal Reserve says at 2 o'clock on Wednesday. Mm-hmm. And over the next 2 weeks, you have a lot of larger size companies reporting their earnings. That's going to be pivotal as well. So I agree with Mark. We're not out of the woods yet from a volatility standpoint. It could get worse before it gets better. But in context, this is normal for the market. And this is the sacrifice you have to put up with as an equity investor. If you want those good long-term rates of return, this is the sacrifice you have to make.
Yeah, absolutely. Well said.
All right, viewers, we'll be back next week with another episode of Questions with Matt and Mark. We'll see you then.